Happy Sunday, everybody. Mo Kama's Sunday service. Today, we're going to be talking about the top trading mistakes that beginners make, including myself. Uh, these are some of the things that I have had issues with over the last year or two. And who am I? I am an attorney that happens to trade on the side to make some extra money. I also enjoy it. I got a couple $100,000 in the market typically, and I've made hundreds of trades over the last couple of years. And so I'm just passing on some information related to some of my worst trades over the last couple of years, right? Number one, trading through volatility. I thought this was number one to bring up just because of what happened last week. We had an FOMC meeting last week on Wednesday, which is essentially the Fed talking, and we had OpEx on Friday. And so some of the worst trades that I've had is when I'm holding through some of these events. Earnings is like number one. I typically am not going to trade through earnings. I'll hold some stocks in my long term portfolio through earnings, but I'm not going to be trading or swing trading, day trading through earnings. Day trading for me is trades you're in and out of that particular day. Swing trading is typically a 1 to 2 to 3 to 4 week sort of trade with the market. It's kind of a more lax, laid back type of trading. For me, people who work, who can't watch the market all of the time, swing trading is preferable. And this is just my personal opinion. I would love to day trade, but I feel like day trading is a full time job. So I'm typically looking for a swing trade, something to be in and out of within a few days to a week, depending on what the market is doing. So that's what I mean by swing trading versus day trading, and long term, which would be like something in my retirement account that I want to hold for 5 years or more. I'm going to hold that through earnings, but I'm not going to day trade or swing trade through earnings. Typically, I'm going to let the market or the stock calm down a little bit, usually a couple of days before I trade after earnings, and I'm trying to get out of a trade before earnings hits. Typically, if let's say if something is reporting on Friday, I'm going to be out of that thing on Thursday, right? So FOMC, what I mean by that is interest rates, right? The market follows whether or not interest rates are going to go up or go down. If interest rates go up, money becomes more expensive. If interest rates goes down, money becomes less expensive. It's easier for companies in the stock market to grow if money becomes less expensive, right? So when we have FOMC meetings, and this week, or I'm sorry, last week, they decided not to touch rates at all to keep them where they are, right? But if they would have decided to hike rates or lower rates, which is what everyone is waiting on, that could potentially make the market react, which is why I say I don't like swing trading through volatility. This was top of the mind for me because I was in a QQQ short right before the FOMC release, which is about 11 a.m. last Wednesday. And I think, where did I get into that short? I think it was Monday. Monday, Nasdaq had a big pop, and the QQQ is the ETF version of the Nasdaq futures, right? Had a big pop at a level where I wanted to short it, so I traded a what did I trade? I traded a call spread. I sold a call spread on it, and it immediately popped down from that level. And for me, it was going great on Monday. It was going great on Tuesday. And then I saw the FOMC meeting coming up on Wednesday, and I decided to get out that morning. And it was the best decision I ever made because it went the exact opposite direction after the FOMC meeting, right? So I've learned to get out right before the volatility on my trades because just in the past, yes, that move could have went with me, but in the past, generally it moves against me. So I'm trying to get out before volatility, trying to get that quick move. Made about $600 on that trade, right? Also, some things triggered on my setups for Thursday but I knew we had OpX on Friday. What is OpX? That is options expirations. Every third Friday is when the most options on stocks and ETFs and futures are expiring. And when that happens, and I don't know why, well, I guess people are rolling over positions, but there's just a lot of volatility for no reason, meaning you can't really predict it. It's not because of news on the stock, like where the CEO reported something bad or something of that nature, or there was some bad data that came out. A lot of times it's just people rolling over or switching positions, and or putting on a different hedge because one is expiring, and so there just tends to be a lot of volatility on that Friday. So if I do trade OPEX, it's typically going to be in the last hour of the market going into the next week. But I'm going to be getting out of, if OPEX is on a Friday, which it typically is, it's the third Friday. I'm going to be getting out of my trades on Thursday. Right. And then the last thing is if the Fed chair is speaking. This also coincides with FOMC meetings, but sometimes the Fed chair will be on the news, will be at some university, at some talk, some conference, and will say something that people will take to mean that he's going to lower interest rates or raise them or do something else with the Fed's balance sheet, and that could also cause volatility. So if I see the Fed chair speaking, that's when I might go, hey, if I'm not already up in a position, maybe I'll wait to get into another position until after he gets off the mic, right? And these aren't the only things that could cause volatility, but for me, lately, these have been the big things. You could also put CPI in there, which is inflation data, but that's also dependent upon what the Fed chair is saying about inflation prior to that. Same thing with jobs data. Is the Fed has the Fed chair indicated he's worried about jobs? Then jobs data becomes more important and could potentially be something else that causes volatility. Also, what are you trading? If you trade crude a lot, you might want to be watching the crude data releases, right? And maybe get in and out of positions before those data releases, right? So it really just depends on what you're trading. But that's rule number one. Watch out for trading through these volatile events. Number two, the biggest thing that I see with people who are beginning, not having a setup, right? Why? What's your trigger for entering a trade? This is why you should potentially think about buying a course or someone that sells a strategy, right? Usually they have a lot of free information that tells you what they're doing, and then to learn more, you have to buy their course. I'm still paying for an options mastery course myself that I've been in for about a year now, and I can say I've spent probably $10,000 to $15,000 over the last few years buying courses, buying tools, buying setups, things of that nature, classes to try and get better with trading. And the one thing you need to have is a setup. What's your trigger? How do you know when you should be entering a trade and when you shouldn't be entering a trade, right? Do you enter a trade on 15-minute range breaks when it breaks the top or the bottom side of a range? And do you trade that with calls or puts? Like that's potentially a setup, right? On a range break strategy. If you trade inside bars, right, the day after an inside bar, do you trade the upside or the downside to an inside bar? And do you tend to trade that with call spreads or put spreads, right? That's your setup, right? That's your trigger. And in my case right now, I mostly trade exhaustion. Is something exhausted to the upside or to the downside? And how do I know that, right? How do I know when something is exhausted? What's my setup, right? So some people just trade to trade. I'm not going to trade just because the market's open. I'm trading because something is triggering on my setup and I have a particular direction, right? Here is where I want to enter. And why? Because I'm looking, and specifically for me, is the sector trending positively or negatively? Okay, yes. If the sector is triggering right now, the sectors are trending negatively mostly, except for gold. If the sectors are trending negatively and I want to go inside that sector, is that ETF or is that stock also trending negatively? And then does it have a pop to the upside? And then how much of a pop do I need it to have to the upside before I enter the trade, right? And for me, I usually want to see some major level that's usually like a price, like if it's 200, 150, right? It has a zero at the end. And do I see a lot of volume kicking in historically over the last 20 days at that area? And then the last confirmation for me is, what does the RSI look like? If I'm trying to short something, I want the RSI to be close to 70, higher than 70, and even better if it's at 80, right? Some people do 30 to 70, but I like the relative strength to be even more exhausted at 80 before I'm extremely confident to try and short that thing, right? If all of these things are lining up, that's my setup to get into a trade. I'm not trading just to trade, but I'm trading because my alerts went off that told me here are all of the things that are in congruence that make this a good trade or a good setup for me, right? Number three, FOMO. If all of those things lined up and I'm at work and I missed it and it already starts coming down, I do not chase that trade. I just gotta wait for another setup to happen, right? And that happens all the time. If you are not a professional trader, if you're not someone that's looking at the market all the time, you're at work for an extended period of time or doing something really important, you can't watch the market all the time, and your alert goes off when you're busy, just because it went off and it hit that price, if it came down and it's not still there, you gotta wait for it to hit that price again. And recently I've been rewarded with this where that will have happened, and then I'll go, you know what, there's still 2 hours left in the market, let me see if it'll come back down a little further or hit that price again. And recently it's been coming down and hitting that price again. I've been getting a better stock, a better price on my trade for it to reverse and come back to the other side. So don't chase stocks, right? It also ruins your risk to reward ratio, because if you're like, if I'm shorting a stock at a peak, if I enter lower, then my risk to reward shrinks, versus if I get it at that peak and here's my target down here, like that's really what I'm looking for, right? That's my risk to reward, and right, if my stop loss is at 20, 25% or whatever it is. But if I chase it and get it further down than where I wanted it, then now this is my reward, right? So FOMO also ruins the trade, because the reason why you wanted to get in the trade is because your risk to reward, your reward was higher. But if you get in down here, then your reward is less, right? So it's another reason not to have FOMO. It just makes your trade worse from like a reward ratio standpoint. Number four, not having a stop loss. You got to know when you're entering the trade where you want to get out. For me, I trade specifically with options. I trade with the 25% stop loss. Mostly just because you got to give options a little bit more wiggle because of the nature of options. They're a little bit more volatile. I trade with the 25% stop loss. So I know the trade goes against me 25%, I want to get out. I'm trying to trade robotically. I don't even want to think about it. I hit my 25%. I'll do it with an alert, but if I go check after the alert and we're down 25%, I am making an order to get out of that trade. That is a stop loss, because like if it's a loser, I want to get out, and then I want to focus on trying to find another winner, get that capital back, and then put it in to another winner. Sometimes though, when you're trading stocks or trading options, the one thing that will happen that is out of your control is a gap down overnight, right? You could have a 25% stop loss, but if the market is not open, it will not get you out of the trade. And let's say we go to war overnight, or Trump puts tariffs on one of your companies overnight that you're trading. And that's when the news comes out, is after the stock market is closed. Something else could happen, right? COVID is announced, right? And everything's shutting down. And if that occurs, then you're going to see potentially you're down 30, 40, 50% overnight, and you didn't even have an opportunity to get out of your trade. That might be the one time where I don't obey my stop loss, where I'm like, hey, let me see if I can claw some of this back at another level. But if you can cut it, cut it. Gap downs are inevitably something that's going to happen, and it's going to happen to you on the positive side too. You're going to get some positive news, and you're going to see a gap up immediately the next day in one of your accounts. So, but I do think it's reasonably important for you to have either an automated stop loss, especially if you're a beginner, and if you're not a beginner, at least have an alert stop loss that tells you to go look once you're down 20, 25%, whatever you decide is good for your account, right? But you should know when you're entering the trade where you want to get out. You shouldn't be determining that after you enter. And see, number 5 would be not having a target. You should also know where you want to get out. In addition, if things go well. So your stop loss is where you want to get out if things go bad. Your target is where you want to start getting out when things go good. The way that I use targets now, I usually have like 3. I want to buy an option that I can scale out of, so I'll buy enough contracts. Ideally, in 4s, right? If I can buy 4 of something or 8 of something, then I can scale out appropriately. So my target number 1 is usually going to be around 25% or more. And I'll use the chart to figure out where there was like a prior high, and I'm looking to get out of a half of my position. Let's say if I buy 8 contracts, I'm looking to get out of 4 at target 1, and then I'll have a target 2 where I'll get a little bit more greedy, especially if I'm selling spreads. Then my target 2 is usually going to be around 50%, because I'm just pretty much just trying to get time decay and premium if I'm selling spreads. And then my target 3 will usually be 75%. So I'll sell 4 contracts at 25 or a little bit higher than 25%, 2 contracts at 50%, and then another 2 contracts at 75%. If I were to have sold 8 credit spreads or 8 put spreads, right? So that's typically how I'm going to set my targets, and that's just for me and how I trade. I will trade a little bit differently if I buy calls or puts because I have more upside. So I might let my runners run a little bit more if I'm just buying calls or puts. But if I'm selling spreads, I'm going to be out of that trade 9 times out of 10. If I get 75% of the premium, I'm out of the trade and I'm on to the next one. Just because I'm not trying to squeeze an extra 25% out of it. And I've learned it's harder to even get out of a spread unless you hold it all the way to expiration, when both of them are pretty much worthless at that time. Number 6, taking too much size. Right, the size that you put on your trade should be based upon your account size. Right now, this is the thing that I've switched this year, and I've seen my account grow a little bit more, at least my trading account, not my long-term account due to tariffs and whatnot, but my trading account is I have been taking less trades and then taking a little less size and just moving on to the next trade. And so for me, I'm trying not to risk more than 1 to 2% of my account on every trade. And right now it's been mostly like around 1%. And that way there's very little chance that I could blow up my account if I have a higher than a 50% win rate and I'm only taking 1% risk on most trades. Then like there's a good chance that my account's going to keep growing and I'm never going to blow up because I'm never risking 5%, 10%, 20% of my account at one time. So what I do is every month I go look at where my account is, go figure out where 1 to 2% is where 1 to 2% of my account is based upon what my average stop loss is, which is 25%. And then I'll go figure out how much I am allowed to risk on every single trade based upon what my account size is. And then if you don't want to blow up an account, that is the best way to start trading is just making sure that you're not risking 20%, 10% of your account on one single trade. Because what if you go on a losing streak? If you go on a losing streak, if I lose 5 trades in a row, I've only lost 5% of my account. If you're trading 10% of your account at one time, you lose 5 trades in a row, which can happen, you lost 50% of your account. So don't trade with too much size. All right, that's my last one. Did I have a bonus one for y'all? Oh, the bonus one is trade with the trend. Um, One of the oldest sayings in the stock market, if you've taken any class, is the trend is your friend. Trade with trend, man. Stop trying to go against the grain so much, right? Like, if something is trending up or down, go with that. Stop trying to wait for something to reverse. Unless it's like in your long-term account, something is down like incredibly, like 50, 60, 70%. Trade with the trend. Go with where the market is going. So with that, let's talk about the stuff that I'm going to be looking at this upcoming week in the market. My disclaimer, which is in the notes of the YouTube live that's on right now in the YouTube video. This is for informational purposes only. I am not an investment advisor or professional. Please relate all your trades and investments to your investment advisors and professionals if you have one. And ideally, do your own research. The whole purpose of this is to get you to a point where you can do your own research, right? So, how do I build my watch list for the week? I usually do it on Sunday in this class, right? So, come on, computer. There we go. Where do I go? I go to koifin.com. It's this free tool online. I talk about it every week, right? They should give me a sponsorship. I come here to the market dashboards, go to U.S. sectors, and then I have all of the sectors that I trade typically ticked off, except for real estate, just because I don't typically trade real estate. It's not volatile enough for me to kind of get some alpha, so I don't. And the liquidity is poor. And then I also put on there metals and mining, gold miners, oil services, regional banks, semis, and oil and gas, because I do trade some of that stuff from time to time, and I just like to see where the market is going. So, if we're looking at the market next week, I was talking to Isaac about this earlier. Everything's negative. Everything, right? We're a post-Trump bump, and now because of these tariffs, right? There's a lot of negative sentiment out there. There's a lot of people losing government jobs. These tariffs are kicking in, and some more potentially maybe kicking in, and there might be some retaliatory tariffs. So things right now aren't looking good from an outlook standpoint in terms of positive sentiment. So what I am doing is I'm looking, my good trade last week was essentially an XLK trade. It was tech. It wasn't quite XLK, but the Qs and NASDAQ is a tech trade. Tech is down. So I think it was one of these days it popped up. Maybe this day. I'll go look at the chart. I'll go look at the Qs to show you exactly where I got in. But I'm looking for pops on semis, on XLY, consumer discretionary, which is mostly Tesla, Amazon, maybe Home Depot, XLK, which is tech, Microsoft, and then KRE, regional banks, and the Russell. Those are going to be the 4 sectors that I concentrate on potentially shorting next week, right? There are also a lot of other negative sectors, but I want to beat up on the weakest. I want to be the bully that beats up on the little kid with asthma that can't protect himself, right? Sorry for that analogy, but that's what I mean, right? Don't beat up on the strong. Beat up on the weakest sector. The weakest sectors right now are semis, consumer discretionary, tech, and regional banks, and IWM, Russell 2000, the small caps aren't doing so well right now. The reason why I know that is because the KRE tracks the Russell 2000 a lot. So I know if the KRE is down, the Russell's probably down too. And then if you are taking something to the upside, the only thing I would take to the upside is gold, either the gold miners, or I usually like the commodity more than I like the gold miners. Gold miners are typically more volatile in my experience. Right. So let us go to think or swim. So if I take my flexible grid, we're on semis. That was the weakest sector. So I don't know. Even semis are kind of starting to round out. Yeah, SMH itself, TSM, I still like that. Even TSM looks like the most negative trend. AMAT, I don't know what the liquidity is on this, but just looking at, let me go check out AMAT. And what do I mean by liquidity? I trade options, so I'm looking at the open interest. Yeah, and so this is kind of what I suspected. Let me go look at the third Friday of April, which should be the 17th. There's some liquidity there. It's a little expensive. So, AMAT, depending on what your budget is, AMAT might be on the list. I like to usually be able to buy 3 or more contracts. This might be a little expensive for my budget. But oh, they even have some actually no. AMAT's on the list because there's some liquidity. I could sell a spread on it. So AMAT would be on the list, right? And when I'm trading, you go, what is AMAT? To be honest, I don't really care. I know it's in the semiconductor sector. I'm not looking to hold this thing for longer than a few days to a few weeks. So I don't really care as much about the fundamentals. I'm looking mostly at the technicals and what sector it sits in. I know AMAT sits in the semiconductor sector. I know the semiconductor sector is negative right now, including the technology sector. So the way the tide is moving right now is going to the downside, right? Here's the whole sector. The weakest in the sector right now, I would say, is TSM. TSM is going to have some more liquidity than AMAT, but I like TSM. I like AMAT being negative, right? And I got a couple of leaps in AMD right now. AMD is back to trending neutral, which I like that personally for my long-term portfolio. Uh, but AMAT, TSM, and then maybe SMH itself. But I really like, if I had to grade them, TSM 1, AMAT 2, and SMH would be 3 in terms of what I would be shorting next week. All right, the next sector that was negative was, it was XLY. Let's just go to the charts for that, because XLY, there's really heavily weighted 2 names. So XLY, yep, still looks negative. However, we got this inside bar. If I see on Monday this inside bar get broken to the downside, then there's a good chance that XLY is going to keep coming down. Right? That's what I would be betting on, especially if I short this. But if we get a big pop on Monday, maybe around 205 will be a big enough pop to start thinking about shorting this. Let me look at Tesla itself. I do need to make a flexible grid. Tesla still looks pretty bad, so I even like Tesla on a big pop to the upside. I had it at 270, I think, on Friday, just because of looking at these past weeks. That was a good level. So it'll probably serve as some resistance. But I have this tool that's called the daily price movement range tool that gets reset every day. So I'll look at what the range is going to be on Monday, and probably that 270 level might be a good level, but I'll look at this tool on Monday to see if it's good or not, right? Same thing, Amazon. I like Amazon's trend is negative still. So Amazon on a big pop next week, I would be looking to short as well, because it is negative and it is inside XLY. which is a negative sector. If you see on my screen, I'm on this side of the screen mostly because it's a daily chart, right? This is an hourly chart and a 5-minute chart, but just looking at a daily chart, my candles are a little bit different. They kind of tell me what's trending and what's not. These are some tools that I bought for my class, right? So looking at XOY, still a negative trend. Tesla, still a negative trend. Amazon, still a negative trend. HD, still a negative trend. All three of those are on my list to short next week, or all four of those, right? And so now let's look at XLK. XLK looks bad. Apple looks good to potentially short. I don't like shorting Nvidia just because like the earnings are good. Anything that has really good earnings, AVGO, same thing. The even in the semiconductor sector, like the semiconductor sector is down, but I feel like those are two of the strongest in the sector. So I want to beat up on the weakest in the sector. So I'm just gonna stay away from Nvidia. They can announce some news tomorrow, and their stock could go to the moon. So same thing with AVGO, just because they blasted earnings. Like they're down even with good earnings. I don't want to beat up on the strongest names. Microsoft still looks good to short. CRM actually looks good to short. I like this steady trend coming down. CRM actually might be a stronger short to me than Microsoft. And then maybe XOK itself or QQQ, which is what I shorted last week. I think I shorted it on this day right here. Actually, let's zoom in on that. Just to kind of show you what my strategy has been. I took QQQ right here on this day. It was on the 17th. That was Monday. Yep, my birthday. It came in here, reached this little tool area. I wasn't even following the QQQ. I just traded through the NASDAQ, right? Because it's really just the NASDAQ. So on the 17th, the NASDAQ came up deep into this little yellow section, which is a daily price movement range tool, where I know it's kind of exhausted. And then I saw at that time on a 5-minute chart that the RSI was up in the 80s. It was way high, so I knew it was exhausted. So I shorted it there, and I think I got out. I got out at least half of my position, if not a little bit more, towards the bottom here. And then this is when I was saying FOMC hit that day. And I think I got out the rest of my position early in the morning when it was still relatively low. And then it popped up again. Right? So that's how I traded the Qs last week. It's probably still on my list to short again if it does the same thing, has another pop up like that. But I'll be watching the NASDAQ to watch the Qs. If it has another pop up to another one of these major levels, I will think about shorting that. The last two things would be KRE, negative, regional bank, same thing. If we get a pop, you'll see on a lot of these charts, I already had like old levels set because I've been watching these for the last couple of weeks because they've been trending negatively. I also like the Russell through the IWM. Same thing, negative trend. On a big pop to the upside, potentially to come down. But through the IWM. And that's really what I'm looking at for next week. There are a lot of other sectors that are also negative, but I want to take the most negative sectors and take those down if I see major pop-ups next week. Right? All right, that's really all I got for y'all this week, unless you want to look at a particular name or stock. All right, since I don't hear anything, Mokama Sunday service every Sunday at 8 a.m. Sorry we got started a little late today. We were talking about some other stuff on the Zoom. If you want to be on the Zoom, hit me up, DM me at MoStacksLA on Instagram or hit me on YouTube. But yeah, man, that's it. That's what I'm trading next week. My trading has been doing relatively well this year by trading less and trading the stronger trends. Um, if it's a weakish trend or a sideways trend or it's not trending that negative or that positively, I'm staying away from it. And I'm just trading the strongest names to the upside or to the downside. And that has been working for me over the last few weeks. So I'm kind of sticking to that, trying to make sure that there's a lot more congruence where I want to make sure that the index is down, the sector is down, and the stock is down so that I'm not really trading against like the trend. And the stronger the trend, the stronger the sector, right? Then the more confident I'm going to be taking something to the upside or the downside. And right now, the strong trend has been the downside. So until that changes, right, it's almost been acting as a hedge in my long term portfolio that's been going down. Making a few bucks on the downside doesn't hurt, helps me to be able to stay in some longer term positions and not feel the hurt as much, especially with all of this uncertainty that's happening with these tariffs, which is the biggest issue right now, right? So, with that being said, I will see y'all next week.